Hi. Let's learn about annual percentage rate, APR. Annual percentage rate refers to the yearly interest generated by a sum that's charged to borrowers or paid to investors. APR is expressed as a percentage that represents the actual yearly cost of funds over the term of a loan or income earned on an investment. This includes any fees or additional costs associated with the transaction but does not take compounding into account. The APR provides consumers with a bottom-line number they can compare among lenders, credit cards, or investment products. An annual percentage rate is expressed as an interest rate. It calculates what percentage of the principal you'll pay each year by taking things such as monthly payments and fees into account. APR is also the annual rate of interest paid on investments without accounting for the compounding of interest within that year. The Truth in Lending Act of 1968 mandates that lenders disclose the APR they charge to borrowers. Credit card companies are allowed to advertise interest rates on a monthly basis, but they must clearly report the APR to customers before they sign an agreement. APR is calculated by multiplying the periodic interest rate by the number of periods in a year in which it was applied. It does not indicate how many times the rate is actually applied to the balance. The formula to calculate APR is APR equals principal, x, 365/n, x 100, where interest is the total interest paid over the life of the loan, principal is the loan amount, and n is the number of days in the loan term. Credit card APRs vary based on the type of charge. The credit card issuer may charge one APR for purchases, another for cash advances, and yet another for balance transfers from another card. Bank loans generally come with either fixed or variable APRs. A fixed APR loan has an interest rate that is guaranteed not to change during the life of the loan or credit facility. A variable APR loan has an interest rate that may change at any time. The APR borrowers are charged also depends on their credit. The rates offered to those with excellent credit are significantly lower than those offered to those with bad credit. Though an APR only accounts for simple interest, the annual percentage yield takes compound interest into account, making a loan's APY higher than its APR. The APR and a different APY can represent the same interest rate on a loan or financial product. Given that, lenders often emphasize the more flattering number. The Truth in Savings Act of 1991 mandated both APR and APY disclosure in ads, contracts, and agreements. A bank will advertise a savings account's APY in a large font and its corresponding APR in a smaller one, given that the former features a superficially larger number. To calculate the APY or effective annual interest rate, add 1 and take that number to the power of the number of compounding periods in a year. Subtract 1 from the result to get the percentage. If you only carry a balance on your credit card for 1 month's period, you will be charged the equivalent yearly rate of the APR. However, if you carry that balance for the year, your effective interest rate becomes higher as a result of compounding each day. An APR tends to be higher than a loan's nominal interest rate, and the daily periodic rate is the interest charged on a loan's balance on a daily basis, the APR divided by 365. Lenders are allowed to represent APR on a monthly basis, though, as long as the full 12-month APR is listed somewhere before the agreement is signed. The APR isn't always an accurate reflection of the total cost of borrowing because the calculations assume long-term repayment schedules, which may understate the actual cost of a loan. Estimates also tend to assume a constant rate of interest, which may be inaccurate for adjustable-rate mortgages. The mortgage APR may or may not include other charges, such as appraisals, titles, credit reports, applications, life insurance, attorneys and notaries, and document preparation. Consumer protection laws require companies to disclose the APRs associated with their product offerings in order to prevent companies from misleading customers by omitting the APR from their advertising. By requiring all companies to disclose their APRs, customers are presented with an apples-to-apples comparison. The definition of a good APR varies based on market rates, the prime interest rate, and the borrower's credit score. APRs offered by financial institutions can be very low, but may only be available to customers with exceptionally high credit scores. Customers should verify if these low rates are introductory offers that will revert to a higher APR after a certain period has passed. The formula for calculating APR is straightforward. It consists of multiplying the periodic interest rate by the number of periods in a year in which the rate is applied. The exact formula is APR equals /principal, x, 365/n, x 100. The APR is the basic theoretical cost or benefit of money loaned or borrowed. APRs are often a selling point for different financial instruments, such as mortgages or credit cards. When choosing a tool with an APR, be careful to also take into account the APY because it will provide a more accurate number for what you will pay or earn over time. Here are 5 key takeaways. 1. An annual percentage rate, APR, is the yearly rate charged for a loan or earned by an investment. 2. Financial institutions must disclose a financial instrument's APR before any agreement is signed. 3. The APR provides a consistent basis for presenting annual interest rate information in order to protect consumers from misleading advertising. 4. An APR may not reflect the actual cost of borrowing because lenders have a fair amount of leeway in calculating it, excluding certain fees. 5. APR shouldn't be confused with APY, annual percentage yield, a calculation that takes the compounding of interest into account. Hope this would help. Thanks for watching.